Hello and welcome to Business Incorporated live on Channels Television. Here's what's coming up. All eyes on Abuja as the Central Bank of Nigeria's Monetary Policy Committee meets for the 10th time under Governor Olayemi Cardoso after 6 straight hikes last year and 3 holds so far in 2025. Will the CBN finally shift gears? It's great to have you on, Ladi Williams. Definitely it's decision day right here in Lagos, Nigeria. We've got decision from other top economies so far, so it's time for ours right now. But let's get a check on what's playing out with some of the markets that we track first. We've seen oil prices ticked higher as investors, they're assessing the global supply outlook following a preliminary deal between Iraq and Kurdish regional authorities to restart a key pipeline. Brent crude futures rose about 14 cents. $66.71 a barrel last time we took numbers, while U.S. West Texas Intermediate crude added about 21 cents, $62.49, clawing back some ground after 4 straight sessions of losses that shaved roughly 3% off both benchmarks. Let's get a quick check on what's playing out with the metals now. See, gold prices climbed to a fresh record high, lifted by growing expectations of further U.S. interest rate cuts following the Federal Reserve's latest policy move. Spot gold, again, about 0.8% to $3,715 per ounce after hitting an all-time high of $3,728.43 earlier in the session, while gold futures advanced 1.1% to $3,748 per ounce. All right, let's get a check on what's playing out in Europe. Now, there's talk about a cyber attack in Europe, but before we get into that, let's get a check now with Lars Holter. Great to have you, Lars. How's it looking over there in the markets in Europe?
Yeah, hi, Ladi. How you doing? You know, the DAX here in Frankfurt is up today, so it is exactly making up yesterday's losses. We've seen that kind of pattern for a while. We're still going rather sideways as we've been for months, and still the mood is rather weak. We got some fresh industry data out this morning, and they're weak, with some analysts now worrying that if order volume for the industry doesn't recover soon, then we will probably see some companies scaling back capacity as well, and that would likely, of course, import labor markets as well. So we are in a fickle situation right now. So the DAX in Frankfurt trading sideways, as frustrating as it is, Ladi, for investors, of course, is still likely a little bit better than what the reality behind the scenes is like.
Yesterday saw long lines at some European airports, including Berlin, and there was talk about a cyber attack. What was the situation like, at the airports there?
Yeah, Ladi, indeed. We're talking about London Heathrow, as well as the airports in Brussels, in Dublin, and then, of course, Berlin International Airport, where tens of thousands waited around for hours with no chance to board. And it was after a cyber attack on a company called Collins Aerospace. Now, they're a maker of boarding and check-in systems that are used by most major European airports. It's unclear as of right now who's behind the attack. No one has yet claimed responsibility, but there have been calls, of course, for an investigation. From what we're hearing, a lot of experts are especially keen on checking if there might just be any links to Russia. It wouldn't be the first cyber attack out of Moscow, of course, but also the timing of this incident raises some red flags. We've just seen these breaches over EU and NATO airspace, over Poland, Romania, and Estonia. It seems right now Moscow is showing its force, and we have long known that warfare today includes tools far from the battlefield, and cyber attacks, of course, being one of them. In response now, airlines and airports around the globe are checking their systems, and they're trying to set up stronger protection against such attacks. And rightly so, we should keep in mind what all can happen caused by a cyber attack. When we are now seeing this one, there was technically not even a bad one. The company that got attacked, Collins Aerospace, like I said, their systems help passenger check in and print boarding passes and bag tags. So attacking them only leads to delays, but other cyber attacks could interfere with the safe operation of flights and possibly even endanger lives. So these cyber attacks, Ladi, they're being taken very seriously.
Do you think it's had, some kind of far-reaching, reactions to other parts of the economy in Europe? What are you hearing about that?
Well, of course, other parts of the economy are just as worried. We've seen cyber attacks in many parts so far, not only traffic and transportation. We've seen them happen to infrastructure, although at this point, not on a large scale. But if that happens at a large scale, you want to be prepared for it. So we're seeing, of course, more and more companies on trying to put up better guardrails against those cyber attacks, because we do know, especially in times of crisis like we're having right now, specifically looking at the Russia-Ukraine situation, we have to be prepared for that.
All right, definitely you need to get the cyberspace as protected as possible, going forward. We keep tracking that development right there in Europe. Thank you so much, Lars Holter, for the details.
Thank you, Ladi.
All right, now I did say it was decision day right here in Lagos, Nigeria, but other top African economies, they've made their decisions. Some are about to also make decisions going forward. And we have John McCraw, who has made her decision about other things to come tell us.
I made my decision in life, laddie.
Exactly.
My investment decision, my decision in life.
You've made all decisions.
I've made all of them.
Yeah. So let's track what Africa is doing now.
All right. Good afternoon, everyone. Well, let's tell you what's going on in other major economies, different regions here on the continent. We'll start from Ghana, even as Nigeria celebrates 5 consecutive drop in inflation, which has paved the way for the possibility of a rate cut today. Well, Ghana has already gone past that. We saw that Ghana's annual inflation fell to 11.5%. And this Ghana used to do much more than this. That is for August. Following the conclusion of the 126th MPC meeting, the Bank of Ghana's Monetary Policy Committee, they announced a significant reduction in benchmark policy interest rate, cutting it by 350 basis points. And that went from 25% to 21.5%, all the way from 25%. That's where it came from. This marked a major rate cut this year. The central bank intensifies efforts to stimulate credit growth and support the country's ongoing economic recovery. So you have it for Ghana. The inflation rate at this time is at 11.5%. For the month of August, and benchmark is 21.5% after that major cut that they did from 25% to 21.5%. So we say congratulations to Ghana. We've seen them record some very positive moves, especially since they started focusing on putting their reserves in gold. And it's domestically produced gold. So that has really helped their economy, helped their currency, and we've seen this major drop in their inflation leading to that. And then we move to Angola, where the inflation rate fell also to 18.88% in August. And that's a new low since November 2023, down from July's 19.48%, extending the decline that was seen in August 2024. The relative stability of the Kwanza, that's their currency, along with improved goods availability, has played a major role in easing inflationary pressures, and prices have slowed down for most CPI items like food and non-alcoholic beverages. We've seen a huge drop in that. Alcoholic beverages and tobacco also, there's been a drop from 20.55 to 21.82. Clothing and footwear also have recorded some drop. Health items, education, restaurants and hotels, they've also had a drop in inflation. And so we see that has led to this drop, a cut of interest rates. So the central bank cut its main interest rate by 50 basis points. That's the latest one that they did to 19%. And then we move to North Africa, where we see in Egypt, inflation there continued to slow in August, according to their data. That's for Egypt, from Angola to Egypt. And the central bank also there, they had an annual basis point where it fell from 12% down from 13.9%. That's for Egypt. The Central Agency for Public Mobilization and Statistics, CAPMAS, and the Central Bank of Nigeria of Egypt. And then on an annual basis, it fell to 12%, down from 13.9%, losing almost 2% in July, marking a significant decline in inflationary pressures. The central bank there lowered its benchmark interest rate by 2 percentage points, and it's the largest reduction in over a year, and inflation eased and economic growth outpaced expectation. The monetary policy there also reduced the overnight deposit rate to 22% from 24%, and they say that it reflects a more favorable inflation outlook for the future. And then we go to giants of Africa, South Africa, whether we like it or not. Here in Nigeria, we say we're the giant, but the most industrialized country remains South Africa this time, so let's do better, I guess. So we see in South Africa, they left their key lending rate at 7%. They called it a tight decision, and holding off from easing monetary policy further while it assesses the impact of previous rate cuts. And the announcement was the first since South Africa Reserve Bank said that it would aim for the bottom of 3 to 6%. That's their target, the range of the target, and an effort to lock in low inflation. South Africa's annual consumer inflation slowed to 3.3% in August on the back of easing food costs. And according to figures released by Statistics, annualized consumer inflation was pegged at 3.5% in July. So, Ladi, you know, we see a positive trend coming the way of the continent. A lot of the major economies are recording reduction in inflation. I know there was a time we're all shouting about debt on the continent, but now we see reduction in inflation, and following that is very well, sometimes reluctant, but cuts in interest rates is what we are seeing as a trend. I know South Africa has cut at a point, even now, the last one they held, you know, but we see the trend of a drop in inflation, which Nigeria is also experiencing. But of course, we have to be very careful about it. Let's not.
You don't want to cut too soon.
Yeah, I don't want to cut too soon because
you don't
Ghana
want to wait
tried
too
it.
long to
Ghana
cut.
tried it. I don't know if you remember some months earlier in the year.
And inflation ticked up.
Yes, you know, but now, well, they have it organized, I believe, because we've seen continuous drop in inflation, which has led to this 350 basis points. That's the biggest we've had on the continent.
I guess
in recent
it's safe
times
to call 2025 the year of the cuts, you know, at this point. But until Nigeria cuts,
exactly.
Then that'll be a complete cycle.
Exactly.
Thank you so much,
Yeah, thanks.
for the details there on most of the African continents that we track and African countries that we track and how their interest rates are looking and inflation. Well, we'll take a break now. When we come back, we're going to go straight into the conversation for this 302nd meeting. That's in a moment. Just stay with us. All right here is decision day in Lagos, Nigeria, but it's happening in Abuja. And yeah, we see the room there. It's getting prepared for this 302nd meeting there. We're going to get the rate decision. We've had consensus. Some say it might be a hold. Some say we'll get a cut today. Spoke with Ini earlier, and it seems like going by what other economies are doing right now, we could call it 2025, the year of the cut, at this point. But, definitely we'll find out in a few minutes what the decision is going to be. But we're going to be giving you analysis here of what's before this Monetary Policy Committee and what to look out for, definitely when it comes to inflation, interest rates, currency volatility, and all of that. And to help us unpack all of this, we have with me Hakeem Mohammed, is the Executive Director, Global Markets, Institutional Banking, FSDH Merchant Bank. I also have right here Mr. Tajuddin Ibrahim, Director, Research and Strategy at Chapel Hill Denham, both here to help us make sense of what's going to happen here today. And, some would say, what is so special about this particular meeting, at this point? In your mind, I'll start with you, Mr. Hakeem. What's special about this one?
I think, it's not different from the other MPCs that we've seen. However, because a lot of things have moved in Nigeria's favor in the last couple of months. So if you think about GDP, just yesterday, GDP numbers were released that showed that the economy grew 4.3%. Inflation has been easing. Exchange rate has been stable. So you say a lot of things are in our favor. And to those who think, interest rates are too high, it's probably a time for us to start to ease, for things to start to ease around that level. You probably would say, yes, maybe it's about time that we get it. But again, we'll see, and I know that the MPC members who are there wrapping up, their discussions will have considered a whole lot of things. Some of these things I've mentioned, there are even some that we don't see, right? And they will then think about what happens to the total economy and decide, what is best to do. But I think interesting days ahead. Even if we don't get what we want today, I think we're closer than we were, for example, when we had this, the first time they met this year in January.
I like the way you put that, even though we don't get what we want. But Mr. Taj, is it special for you?
So it is, because it looks like the turning point in terms of how costly do we want to let borrowing stay. Borrowing costs for businesses are very high, and the question now is that could this meeting be like the turning point where borrowing rates will begin to come down, and then more businesses will be able to borrow, more businesses will be able to make expansion decisions, and also for more businesses to begin to think about the next growth expenditure. Because most of the factors that are sort of not encouraging, interest rate seems to be like a major element. And there are a lot of businesses on the sideline waiting for an interest rate cut by the CBN before they come to the market to come and issue commercial papers. There are some that are waiting on the sideline to come and issue bonds for liquidity management, liquidity purposes, and largely speaking also for business expansion, for long-term money in the capital market. So all of those are the reasons that we have today being a major one, which is looking like a turning point for the economy.
Right, I know businesses love patient money, but at the same time, I think they love more cheap money.
Cheaper money is good, not just for businesses, but also for the entire economy. Because when you borrow at a relatively cheap rate as a business, you have little or no incentive for you to want to increase your prices. And when your prices are stable, what most likely you would see is an increase in demand. And an increase in demand means that consumers are consuming more. When you consume more, you grow the economy.
Right. All right, let's look at some of the data. I guess the data, looking good. We see a money supply trend from April 2025 up to June. Started about 119 trillion. Then we're at 117 trillion from the last data. We'll do a throwback to the last meeting. Monetary policy rate, 27.50%. Cash reserve ratio, 50%. Liquidity ratio, that's at 30%. That's for the last meeting. And I'm wondering, since the last meeting, since this decision, Mr. Kim, in your opinion, what has changed since this last meeting decision?
Okay, quite a lot. So just to give a sense, and I will just go maybe to the different segments of the market. So on exchange rate, for example, just before the last meeting with the Trump war and all of that, drama that happened in April, we did see pressure come on the currency. Our rates went as high as maybe 1640, 1650. But since then, we've seen things sort of, stabilize, and the currency has appreciated to just under 1.5, today. If I go on the fixed income side also, we've also seen yields appreciate. We've seen a rally in the market. On a year-to-date basis, we've seen almost 480, 500 basis point rally. At the beginning of the year, 10-year government bonds was trading around 22.6. Now it's around 16.4, 16.5%. So we've seen quite a lot, feeding through. The central bank, though, since last meeting, since that was a specific question, they've sort of slowed down on OMO issuances. And now, and we're now seeing very huge liquidity in the market. So on the average, maybe something around 2 trillion is what we're seeing in the market. And every time there's maturity, and you think, oh, maybe they will come into the market to mop up, they've just not done that. And even when they did, the few times they did, they've come and they've issued very short-dated papers, that will mature November, December. And that's why today's MPC is very interesting, because when we're asking ourselves, what would they do when those maturities come in, the very large ones, November, December? We have more maturities of about 3 trillion, 3.1 trillion in November, another same kind of figure in December. So what would they do? Are they planning to, because clearly one thing that I believe is on their minds is the cost of those OMO issuances. However, the fact that they've kept the standing deposit facility rates at 26.5 has sort of kept rates high. So one of the things that I'm looking forward to today is, even if they don't cut a rate, because I think it's probably too early to start to adjust MPR now, because there are still some risk factors. Inflation is reducing, but it's still high. Exchange rate is stable. I don't think they want to upset all of that. However, I'm hoping that the asymmetric corridor is something that is still available for them to tweak. Tweaking it potentially will help them, one, reduce the rates, and in a way, we can also allow even the market to adjust, the interest rate levels. Because today, if you, as a bank, if you have any excess liquidity, you can get 26.5, right? So why would you want to lend to a customer at 25 when you can just go give the same funds to CBN at 26.5? So for me, those are the factors, those are the things that I believe, they will have considered, and that's what some of the things that I'm looking forward to see, how they pan out today.
Right, and definitely, Mr. Taj, quite an interesting perspective there. What we've seen with the OMO activities, from the central bank at this point. In your view, why are they not mopping up?
So I believe that not mopping up is already indicative of we are going to the next cycle.
Yeah.
In July, average daily liquidity was 364 billion naira. In August, it was 694 billion naira. But they allowed it to build up to 1.93 trillion naira in September on average on a daily basis. That looks like an 83% increase when you look at it month on month. And it is something that I believe is that they are sending a signal around we are coming to begin to start a dovish monetary cycle. So you don't just start a cycle suddenly like that. You have to prepare the ground for it. And Akim mentioned, some maturities, big maturities coming up in November, in December. All those maturities, to my mind, will land in the financial system, and there'll be little or no aggressiveness on the CBN to mop them up. So that's already to wet the ground for them to begin to consider cutting interest rates. When you cut interest rates at that point, then you would see that the system is already prepared. It will not be like a sudden, decision. The second thing I would like to speak to briefly is that we have the asymmetric corridor being minus 100, for lending or borrowing from the banks. That, to my mind, is something that they should take to minus 500. Because as we speak, 19.3% is the discount rate on OMO. That's what they will give, to investors on like a 1-year basis. But we have 26.5% there that they are giving to banks. The same banks you give 19%, you're also giving them 26.5%. Why don't you adjust that corridor to like minus 500, so that you are not giving them more than like 20-21%, and it looks like an equal discount rate on both sides.
Right. So definitely a lot to unpack there, but I guess for money you would want to go where you're getting more more bang for your buck.
Sure.
This time as a bank. So,
Sure.
Looking at what's played out, so far, high interest rate environment, definitely businesses, private sector have complained, saying it's time for us to cut the rate, but there's also that balancing act. You don't want to cut too soon, and you don't want to be too slow. We've seen the pressure on the U.S. Fed chair coming from President Trump, so far. Although, I guess Cardoso doesn't have that.
Sure.
Governor Cardoso is not really stressed, that much. But does this put pressure on this MPC to actually cut rates, in your opinion?
I don't think so. I think they would, they've been tasked with that responsibility of looking at the bigger picture. So what they would say, and I think this particular MPC is actually a very important one, because this is the time when it looks on the face of it as if it's time to cut. But because on the balance of, you need to balance of probabilities, you would say perhaps it's not yet time. What I expect that they would do is that they might signal their intentions, right? And
so should we pay more attention to what is done or what is said going forward?
I think both. So they are going to come today, and maybe they would say, because of heightened risk of external risks, right? Inflation is still high. We think, and we still need to continue to maintain the stability that we see in FX exchange rates. They will say, okay, for now we are holding. But when they then release the minutes of the meeting, the one that has their comments, that's when you start to gauge how they arrived at that decision, right? Clearly, things have already moved in our favor. The country we've been on this hawkish stance for a while. I expect that they're going to give some indication around their dovish tilt going forward to say, okay, based on where we are, things are not so bad. There might be time. This might be the time to start to look in the other direction, because again, you need to drive growth. Yeah, it's a good thing that GDP growth is sort of showing some positive momentum, but at the same time, from a central bank perspective, right? They will be thinking, how do we ensure that we don't upset some of these gains that we have?
Right. Definitely, and we see the governor is seated now, and at any moment from now, we're going to get the decision and the briefing from Governor Olayemi Cardoso for the 302nd meeting. So we'll see the governor there getting ready to give us that decision, and definitely we'll be tracking that as soon as he starts. But I'd like to get your bets. At this point, any surprises? What's your bet?
I'm not looking for any surprises. I think it is not in the interest of the economy, bearing in mind where we are in terms of interest rates, and more importantly in terms of inflation rates. Inflation, I reckon, can still be as high as 29-30% for December. Not because prices are rallying excessively, but more due to the fact that it will reflect the base effect, because they rebased it in December last year.
Okay, I see the governor speaking now. Let's hear.
302nd Monetary Policy Committee MPC meeting of the Central Bank of Nigeria, CBN, was held on September 22nd and 23rd, 2025. The committee reviewed key developments in the economies, including the outlook. All 12 members of the committee were in attendance. Decisions of the MPC. The committee decided as follows. 1. Reduce the monetary policy rate, MPR, by 50 basis points to 27%. 2. Adjust the standing facilities corridor around the MPR to plus 250 to minus 250 basis points. 3. Adjust the cash reserve requirement, CRR, for commercial banks to 45% while retaining that of merchant banks at 16%. Also, to introduce a 75% CRR on non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision to lower the monetary policy rate was predicated on the sustained disinflation recorded in the past 5 months, projections of declining inflation for the rest of 2025, and the need to support economic recovery efforts. The MPC also adjusted the standing facilities corridor to improve the efficiency of the interbank market and strengthen monetary policy transmission. The committee further introduced a 75% CRR on non-TSA public sector deposits for enhanced liquidity management. Considerations. The MPC expressed satisfaction with the prevailing macroeconomic stability evidenced by the improvements in several indicators. These include the sustained disinflation, improved output growth, stable exchange rate, and robust external reserves. It particularly noted the increased momentum of disinflation in August 2025, being the highest in the past 5 months. This deceleration, underpinned by monetary policy tightening, exchange rate stability, increased capital inflows, and surplus current account balance, have helped to broadly anchor inflation expectations. Other factors that contributed to the deceleration include the continued moderation in the price of PMS and the notable increase in crude oil production. In the view of the committee, the stability in the macroeconomic environment offered some headroom for monetary policy to support economic growth and recovery. Notwithstanding the consistent deceleration in inflation, the committee observed the persistent buildup of excess liquidity in the banking system, resulting largely from fiscal releases emerging from improved revenues. Being mindful of the need to preserve the prevailing macroeconomic stability, the MPC noted the risks posed by the excess liquidity in the banking system. Members noted that effective functioning of the interbank market remains critical to enhance transmission of monetary policy. This, therefore, informed the decision to adjust the width of the standing facilities corridor to boost interbank market transactions and enhance the stability of the market. The committee acknowledged the continued stability of the foreign exchange market and its critical importance in achieving rapid disinflation, and therefore called on the bank to continue the implementation of policies that would further boost capital inflows and deepen foreign exchange liquidity. On the financial sector, the MPC noted the continued resilience of the banking system, with most of the financial soundness indicators remaining within their respective prudential benchmarks. Members also acknowledged the significant progress in the ongoing bank recapitalization exercise, as 14 banks have fully met the new capital requirement. They therefore urged the bank to continue the implementation of policies and initiatives that would ensure the successful completion of the ongoing recapitalization exercise. The committee further noted the successful termination of forbearance measures and waivers on single obligors, which has helped to promote transparency, risk management, and long-term financial stability in the banking system. The MPC reassured the public that the impact of the removal of forbearance is transitory and does not pose any threat to the soundness and stability of the banking system. Price and other domestic developments. Headline inflation year-on-year moderated further to 20.12% in August 2025 from 21.88% in July, driven by the decline in both food and core inflation. On a month-on-month basis, headline inflation also decreased to 0.74% in August 2025 from 1.99% in the preceding month. Similarly, core inflation year-on-year eased to 20.33% in August 2025 from 21.33% in July, due to the slowdown in the cost of services, housing and utilities, as well as transport and logistics. Food inflation year-on-year also moderated to 21.87% in August 2025 from 22.74% in July, attributed to the decline in the price of staples, especially rice, guinea corn, maize, and millet. On output, the recently released GDP for the second quarter of 2025 showed the sustained resilience of the Nigerian economy, with a real growth rate of 4.23% year-on-year, compared to 3.13% in the first quarter of 2025. The committee particularly noted the significant improvement in the performance of the oil sector, which grew by 20.46% compared to 1.87% in the preceding quarter, a positive development that is expected to further bolster foreign exchange reserves and sustain stability in the foreign exchange market. In this regard, the committee commended the efforts of the federal government and called for continued vigilance to strengthen the momentum of security across the country in order to increase oil output and food production. Gross external reserves remained robust at $43.05 billion as at September 11, 2025, compared with $40.51 billion at the end of July 2025, with an import cover of 8.28 months. Similarly, the second quarter 2025 current account balance recorded a significant surplus of US $5.28 billion compared with US $2.85 billion in first quarter of 2025. Global developments. Available projections indicate that global output recovery is expected to improve on the back of favorable trade negotiations and monetary policy easing, particularly in the advanced economies. However, persistent geographical tensions and lingering trade uncertainties could disrupt global supply chain and dampen the outlook. Global inflation is projected to sustain its deceleration, albeit at a slower pace due to the impact of trade tariffs and other structural challenges. This trajectory has necessitated a cautious and data-dependent approach to monetary policy easing by central banks, especially in emerging markets and developing economies. Outlook. Staff projections suggest a sustained disinflation over the coming months, driven by the lagged effects of previous rate hikes, continued stability in the foreign exchange market, and decline in the price of PMS. Furthermore, the onset of the harvest season is expected to increase local food supply, moderate food prices, and contribute to the overall decline in inflation. In its commitment to achieving the core mandate of price stability, the committee will remain proactive through a data-driven policy response. The next meeting of the committee is scheduled for Monday, 24th and Tuesday, 25th November 2025. Thank you.
Thank you, Mr. Governor. That was communique number 159, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso. We'll now take some questions from members of the press. Please state your name, your medium, and you answer the question. And as usual, you are entitled to just a question. Thank you.
Good afternoon, Mr. Chairman and other esteemed members of the MPC. My name is Linus Ukwe from Radio Nigeria. Mr. Governor, sir, very recently the Central Bank of Nigeria unveiled a new framework for East Payment System Vision 2028. Please, sir, can you speak more to it? What does this mean for the financial system in Nigeria and ultimately for Nigerians? Thank you.
Thank you very much, Linus. Let me first say that the Nigeria Payment System Vision 2028 is the attempt to fashion out a payments framework within a constantly evolving ecosystem. As we know, the ecosystem, if there's anything that we generally see with technology and with payments, is that things are constantly evolving and changing all the time. And we need to ensure that we are in step with those changes. Why is that important to us? Because ultimately, we appreciate how a strong and virile payment system helps to lift people out of poverty. And so, with that responsibility of ensuring that our payment system is fit for purpose and is one that meets the aspirations of the financial system and businessmen, a new strategic framework for the next 3 years is being designed. Ultimately, we believe that the impact of this particular framework will be that it will enhance access for financial inclusion, particularly people in the rural areas who perhaps may not have had access in the past, and we know that this has to be a continuing focus of the central bank. Also, we believe that it will enhance security so that the problems you may have had in the past with payments will be significantly reduced. And of course, it will enhance efficiency so that the downtimes and things like that will be significantly reduced. Net, we believe that the bold, futuristic outlook is one that is going to be very positive for the Nigerian economy. And let me also conclude by saying something that I believe is very important. In fashioning out the future on the payments and on the vision, we feel that it is very important that the leadership of the central bank be very, very, very much on tone and able to set the path and talk and walk the talk. And that is why more recently, a couple of months ago, we had a retreat, and the theme of the retreat was basically on digitization and AI. And this is all towards the path of ensuring that we are able to lead from the top and ensure that matters such as this are given the utmost attention for the betterment of all Nigerians. Thank you.
Good afternoon, Mr. Governor and other management staff. My name is Sarah Chimogu, Channels TV. My question is, the issue of regulatory forbearance for certain Nigerian banks seems to be a current topic in the media. The CBN began a phased withdrawal of these measures in June 2025. What is the CBN's position on this matter and the reported intentions of some of these institutions to distribute dividends to shareholders? Thank you.
Thank you very much, Sarah. And here again, let me start off by saying that the issue of forbearance is an issue that has been an ongoing conversation since we took the saddle of responsibility at the central bank. It has been an ongoing conversation. And in particular, last year, we had a number of different dialogues with the banks. And we believe that it is something that the banks themselves should have done earlier. But that notwithstanding, we are pleased at the responses that we have seen so far. And we are steadfast on the date that we have given with respect to the exit of forbearance. In particular, as many of you may know, there are three restrictions. One is the issue of offshore investments, the other is dividends, and of course, payment of bonuses. We are pleased, as I said, that some banks have already commenced well in advance of exiting the forbearance, and we believe that going forward, we will see the banks complying fully. Of course, those who comply are very welcome to go back to the regime that was in place before we came out with this particular circular, and those who are not, well, they stay until they are. Thank you.
Good afternoon, Mr. Governor. My name is Mark Tibo from Leadership Newspapers. Recently, you were part of the presidential delegation to Brazil, where you met with your Brazilian counterpart, the president of the Bank of Brazil. And we noticed that you had some meetings with him. Can you please give us an idea or the takeaways from that meeting, which we think could be important to us? Thank you.
Thank you very much. Yes, I can understand your saying my counterpart, central bank governor, but beyond that, his name was Galipolo and my own name is Cardoso. Yes, it was a very interesting and engaging encounter. Very interesting, in the sense that, as you know, Mr. President went on a state visit to Brazil, and I was very fortunate to be included in that entourage, and I was very honored to meet with the President of Brazil. And I was quite impressed, frankly, with the enthusiasm that greeted the delegation that went from Nigeria to Brazil. As you all know, there are very strong historical ties between Brazil and Nigeria, very strong historical ties. And getting there and seeing the response to the delegation was really quite impressive. Now, for me, I had the privilege of meeting with the governor of the Bank of Brazil, and I went with a number of people from the central bank, and we had extensive dialogue. Some of the things that we spoke about extended to the whole issue of how we can support the potential trade, the potential trade opportunities between Brazil and Nigeria. Because without a very strong and virile banking system that will support that enthusiasm, then we would have done a disservice to our country. And I was very pleased with the responses that I got. In actual fact, we are setting up a technical committee on both sides that is planning to look at these particular issues and see how we can enhance, deepen collaboration between Brazil and Nigeria. Beyond that, beyond the immediate of enhancing the trade opportunities, I'm sure many of you may know that Brazil, over the years, had also gone through rather challenging period in its financial development. At one point in time, the country itself was heavily dogged by inflation, price instability, etc., etc. So it was, of course, today is a completely different story. I mean, Brazil is one of the leading countries in Latin America, and a lot of people and stakeholders go to learn from their success stories. So we also use that visit as an opportunity to engage and to see how we can share experiences, both in terms of monetary policy and inflation targeting, and in terms of financial policy and financial regulation, and see how we can exchange, have good collaboration and exchanges between the two countries to enrich the things that both sides are doing.
Good afternoon, Mr. Governor, and good afternoon, everyone. My name is Musa Abubakar with NTA. My question is, at the fireside chat of the European Business Chamber, Nigeria, you pledged to protect the financial stability of this country with the utmost zeal. The question is, why should Nigerians trust the central bank under your leadership when many still face economic hardship? Thank you.
Thank you. Thank you very much, Musa. Why should Nigerians trust the central bank with me at the helm of leadership? Now, let me firstly go back, and because sometimes it's good to remind ourselves about where we are coming from. And if you recall, we have basically come from 2 years ago, where perhaps things were in a very, very, very bad situation. Very, very bad situation, especially in terms of the macros. We know foreign exchange was difficult. We know that many of the investors had taken flight. And we know that people had lost confidence in the currency. We have moved forward in stabilizing the economy. We have moved forward in stabilizing the economy. The reforms that we have undertaken have been reforms that we have been open and transparent about, and that have brought results, and people can see the results because the numbers speak for themselves. We have had a situation where more and more recognition is being given, not by us, but by the international community. Bear in mind that many of the agencies who look at different countries for a living, Moody's, Fitch, etc., the rating agencies, they have, over the past 2 years, been very, very, very systematic in improving the rating of Nigeria and actually hailing the reforms that have been taken. So yes, we hear you in terms of the question you asked, while certain things still prevail. But I think the response to that is that this is a journey. It isn't it's not a short dash. And in that journey, we have come a very long way in creating that stability, which will now serve as the platform for growth. And that is something that, as I said, the numbers do speak for themselves, And we're confident that if we continue in that trajectory, a lot of the pains, as they have started to ease, will continue to ease. I have no doubt about that.
We have the decision right there, 50 basis points cut. That's for the MPR. Then we see the corridor there, plus 250, negative 250 for the asymmetric corridor. CRR for banks reduced to 45%. Merchant banks, that was retained, 16%. Then we have the non-TSA public sector deposits at 75%. Yes, so I still have here Mr. Hakeem Mohammed, Executive Director of Global Markets, Institutional Banking, FSDH, and Mr. Tajuddin Ibrahim, Director of Research and Strategy, Chapel Hill Denham. So the D-Day has come. We have decision now. I'd like to get the biggest surprises for you, but I'll start with you, Mr. Hakeem.
I think the biggest surprise for me is the CRR on non-TSA public sector deposits of 75%. Because on one hand, you know, they set up the MPC reduced the CRR for commercial banks to 45, right? But on the other side, they've taken another 30% on public sector deposits.
For merchant banks, for you,
yes,
retained at 16%.
Yeah, so I mean, I in particular, we're neutral. But if you think about the system, you know, those deposits that would leave the banks, right, to the central bank on this CRR, I think is a big game changer. So banks will start to think twice again about these public sector deposits. Because remember, the way CRR works is, if you take $1 billion, you have to give 750 to the central bank at zero. And that doesn't stop the customer that gave you those deposits. So let's think about NNPC, for example. If I'm a bank that got $1 billion from NNPC, CBN is going to debit me. So of course, today they've debited 50% already, right? But now they are going to debit additional 30. Although, no, additional 25, because we are coming from 50. That additional 25 is going to go back to the CBN at CRR at zero. Meanwhile, NNPC can still see the $1 billion in their account. So the day they want to make any payment, they send you a check, and you have to wire it. Fantastic. So for me, that's the biggest, I think that's the biggest surprise. You know, right. on the corridor, you know, I was expecting that they would do something, but I didn't think it was going to be this at this level. I know, you know, the Tajuddin had said maybe 500 basis points, but again, you know, right. Maybe I should let you.
Absolutely.
Yeah, you got 250 instead of 500.
Absolutely. I think it is sizable enough, you know, because what it does is that it allows for, you know, flexibility around all of the rising, you know, interest rates that we are seeing in the financial markets. And also, all of those interest rate increases are transforming themselves into borrowing rate in the real economy. And a 50 basis points cut to my mind at this time is a surprise, but I like it. It is a positive surprise. Sometimes you like surprises when they are positive. So because what it means is that borrowing costs for businesses will now be lower. All of those businesses that have been on the sideline wanting to borrow money are now encouraged to borrow money from the capital market. They are also encouraged to begin to speak to their bankers around borrowing money for business expansion. That is what we are looking for. And I think it also sends a signal around what we could see in terms of economic growth from like the final quarter of this year onward. When you borrow at a relatively cheaper rate, you are able to do more. When you do more, you add value to the economy. Right. When value is added, the economy grows further.
But, you know, in my mind, as a businessman now, okay, about 50 basis points shaved off the MPR. I'm still at around 27%. And maybe when I go to the banks, it's still going to be above that. Do you think I'll be really, really encouraged
I think
with a 50 basis point?
I think you will, because what the banks now would like to do is to also scale down on their borrowing, on their lending rates, because they know that this cut implies everything in the economy should be seeing lower interest rates. That's number one. Number two, it sends a signal around future cuts of interest rates. And so the earlier they begin to lend more, the better. And when the reverse is the case in terms of lending and borrowing, are you the one coming to me as a bank to borrow, or I am the one chasing you as a bank to come to want to lend to you? So the situation will now sort of reverse. Instead of you coming to me to come and borrow, I will be the one now chasing you to lend money to you, because I want you to lock in at current interest rates before they begin to cut further. Because we can still see further like 200, 300 basis cuts, point cuts within the next 6 months, in my mind.
Right. So the asymmetric corridor, some of us might not really understand fully what this corridor, means. Help us break it down, at this point. Plus 250, negative 250. It's all about the banks, where the bank will stash cash. Either you're lending or you are depositing, cash with the central bank. Help us break it down, fully.
Okay, so I think one good thing that the MPC has done today is that they pivoted from their tightening stance to a more stable approach, where it's clear that their intention is to support growth in the economy. And if you think about where we were coming from, the corridor was -1 plus 500. So meaning, if you wanted to deposit your balances with the central bank, you get paid 26.5. But if you want to take from the central bank, central bank is usually called the lender of last resort. If you want to go and ask them to lend to you, it will be 32.5. Now, what they've done today, by reducing the MPR by 50 basis points and also moving the corridor in 250 by 250, is that banks can now go borrow from central bank at 29.5. So in a way, this is actually, for me, this is actually more influential than the 50 basis points token drop, cutting rate. Now, before maybe yesterday, my view was we are going to see the central bank, adjust the corridor, and maybe there will be a token 25, 50 basis point cuts. But that changed, yesterday. I had some conversation, and that my view changed. So what they've done today, I'm not very surprised, because what it then means is that the inflation that we're seeing, the central bank, they see more than we see from the outside, because they have all sort of data that they look at. They probably have more confidence in the trend that they are seeing, and they believe the downward trend in inflation will continue.
Right.
So that's one. They also believe that, and obviously, if you check, the FX reserves are up to 42 billion now. I mean, that's what we're seeing as 30-day moving average. It's even possible that those numbers are, closer to 42.5, 43. Again, depends on what they're saying. So they can see it. So they believe the FX story, and they believe that, they have confidence in what they've done and the system, that the system will be able to enjoy what it is that we have here. And they think, okay, it's now time to support businesses. So I expect that the business sentiment will improve, and that folks the real sector, who have been clamoring for this for a long time, there's now light at the end of the tunnel, for people like that. And they will think about it and say, if banks who were earning 26.5 on their excess deposits, now that thing is down to 24.5, so that's actually a 2%. I mean, if you look at it on the headline, you say, oh, it was just cut by 50 basis points. But there's actually a 2% impact that we will see directly. And all of that would be passed on to customer in one form or the other. So, to actually be frank, the market has actually moved, or at least on the corporate credit side. The bigger corporates are actually already borrowing sub MPR. So what it then does is that it then gives even the guys who are a bit lower than that the access to be able to start demanding for lower rates. And that should then help growth overall.
Right. All right. So looking at 2 years now under Governor Olayemi Cardoso, he did come in 2024 January, came with a rate hike, and we've had 6 hikes, 3 holds. Then this latest meeting, I'm sure you know the song, the first cut is the deepest.
Yes.
Is this the cut we've been looking for? And looking at what has happened today, a cut is normally seen as dovish. Mm-hmm. But is there some hawkishness within what has happened today?
Yes, there is some element of hawkishness. When you look at the non-TSA CRR that they now introduced, which is at 75%, And what it implies, Akim, earlier explained it. What it implies is that you are being dovish on one side and then being hawkish on the other side. So which means we most likely are going to see a situation where non-TSA businesses or organizations would then, over time, be willing or could be willing to want to move into the TSA arrangement, just so that they don't have this kind of a development. What we need is one of the things we need is what we are saying. We need a lot of transparency. If your money does not go through the TSA accounts, how transparent are you as a government parastatal? So you may not be as transparent as you should be. But with this kind of a thing, it is likely that if you don't want this 75% CRR on your bank account balances, because banks will not be willing to collect those deposits. Just like Hakim explained it, that is spot on. So you would then over time be thinking, should I go and join TSA? And I think that's most likely be the way for them going forward.
Right, and I guess at the end of the day, that translates to more transparency.
More transparency,
to,
absolutely.
Public funds.
Absolutely, more transparency, which is one of the things that Nigerians are calling for. And I think maybe we should give some credit to the current administration on the back of that, because we have had one or two administrations. Don't forget that this TSA started with the Jonathan presidency. And then Buhari had like 8 years. These non-TSA accounts were still outside of the TSA structure. Now that we have the CRR of 75% on them, I think it may begin to encourage them to consider, let's go to the TSA. Let us be more transparent.
They will have everyone. Or
everyone in TSA,
and
to my mind, that is the most efficient system in that case.
Right.
Because when you put your money in the banks, they get 0% interest on it. So it is not an efficient way of managing your liquidity, of managing your cash flows.
All right, so looking at the non-TSA public sector deposits at this point, we did talk earlier about the NNPCL at this point. Mr. Akeem, what do you see happening here when it comes to the NNPCL? They are non-TSA public sector, parastatal, at this point.
I think it changes the game, right? Today, NNPC banks with whatever bank they want, right? But like you just finished explaining, if as a bank, I will be charged, extra 30% on NNPC deposit just because I'm keeping it. And I know that NNPC, because obviously those funds are sitting in their accounts, so they have their liberty to send in a check to move it anytime they want. So I'll be a bit careful with some of these deposits going forward, right? It will have to be because I have a need and there's something some benefit I can get out of it, because otherwise, if you have to pay 75% CRR on a deposit where you then know that if they show up the next day to take their funds, you don't have control over it. Then you start to think about it. Then I believe people like NNPC will then start to think about, because if you go to this bank is not willing, this other one is not willing. You start to think about going back. You willingly wanting to join TSA, because that way, there's really nothing for you to lose. And I think that will help the system overall. The tax reforms bill, right? The government is trying to centralize the revenue service. In fact, that's what FIRA is supposed to be called now, once maybe in January or so. They want to call it Nigeria Revenue Service. That is supposed to collect revenues for governments, all the government agencies, right? Now, I know NNPC, there's been some arrangements, so NNPC is now like a private company, But again, for now, this is good for Nigeria, because like you mentioned, in terms of transparency and trying to let people have access to what is going on at NNPC, the central bank will have more visibility now. If you recall, a couple of years ago when the former governor of Central Bank, who was the former emir of the current emir of Kano, one of the emirs in Kano, he had said at the time that even at the central bank, who is the banker to the government, that they were not seeing some NNPC flows. That's because NNPC has this liberty to do things just on their own. So what the central bank has done today is going to promote transparency, and I think it's a good thing for the country.
And I'm trying to imagine, all of you in the financial services sector at this point, I know you will be having a lot of conversations today, and you're in that, sector. Just talk to me about what you guys will be really talking about after this.
Yeah, so we'll be looking first of all, because again, for us, we manage liquidity, right? So we're looking to see, okay, what is the net impact of all of this? Because on one hand, the CRR for commercial bank has been reduced by 5%, but there's another 30% going up from public sector. So everyone will be trying to figure out, okay, what does that mean on a net basis for the industry? If it takes out more liquidity from the system, which I think it would, then that takes us to the point he made earlier. It appears as if they're trying to pivot to being dovish, but we're seeing hawkish moves. They are mopping up on one side and releasing on the other side. But I think overall, and that for me is what I think based on my own, but obviously we still need to look at the numbers to be sure of where things stand. But I think on a net basis, they are going to mop up liquidity here. But one thing that I hope they've considered, because they've also taken a gamble, the US Fed have cut by 25 basis points. We do have investors, foreign portfolio investors in Nigeria, who on a normal day, right, when they are cutting in the US, you want to attract some flows here, people who might be chasing higher yields. Now, what this is saying is that on an overall basis, if you are a US investor who is investing in Nigeria, your interest differential is lower by 25 basis points by what's just been done. Because on one hand, there is 25 basis points off there, but you've done 50 here, right? So they'll be thinking, okay, what's their next move? So which is why what the CBN is going to do post this MPC will be critical. Like I mentioned, there's about 2.1 trillion liquidity in the market today that central bank has not mopped up for a while. So what will happen now, as well as when you have those huge maturities that will come in November, December, we have about 4-point-something trillion that will come in between OMO maturity, NTB maturity, and coupon payments. So all of that are liquidity that central bank is going to be interested in. The market will be interested in what central bank does. But what they've done today, at least the benefits that I can see straight away, is that it helps them to reduce their cost of OMO, right? Because if rates are going to be lower, then it means that when they issue, they'll issue those securities lower, and ultimately and overall, they are going to reduce their cost of monetary actions.
Thank you for painting the picture there for the fixed income market, but I know investors in the equities market will also be interested in what's going to happen next. I just had peeked into what's playing out. The market is closed right now, but it seems it's closed in the red.
Yeah, sure. So I think for the equities market, it is positive from the standpoint of, number one, valuation. When you have lower interest rates, what it means is that what feeds into your valuation is now lower in terms of the weighted average cost of capital. And that improves the valuation that you eventually get. And that means you should be buying more equities going forward. That's number one. Number two, it is slightly negative for the banking sector because the banks thrive more in a high interest rate environment. So now we have interest rates coming down. It means they have to think out of the box to see how much more money can they make elsewhere apart from interest income. So now we come to fees and commission income, where they have to ensure that they have more loans that they are booking so that they can take some fees on that. They also have to ensure that they are doing a lot more around payments so that they can take fees. They also have to ensure that they have other sources of non-interest related income. That is what they have to focus on going forward. The third element to my mind is that it is substantially positive for the non-banks that are listed. I'm talking about the likes of MTN, Nestle, and so on, non-bank businesses, because what it means is that they will be borrowing at a much lower interest rate. When you borrow at a much lower interest rate, it improves your PBT. And then eventually your PAT should also be positive on that front. And eventually you would be reporting higher profits. Reporting higher profits suggests that investors in the market should be buying more of your stocks. And with that, you will see a re-rating we call it re-rating when we say that you move the valuation from like 2.5 times PE ratio to like 5 times PE ratio. That is re-rating. So we will see a lot more re-rating for the non-banks on the back of this positive development. And bear in mind also, this is just the beginning. And the earlier you get there as an investor, the better for you, because there'll be further rates, in the coming quarters.
So is it safe to say, seeing that forward guidance looks like we'll see more rate cuts, going forward, is it safe to say it's bearish for financial services?
So it is safe to say that it is bearish for them, because when interest rate was rising, it was a positive thing for them. They were reporting high net interest margin, and particularly for those of them that could mop up cheap deposits from the banking, from the customers, they were able to have much lower cost of funds, but the yield on assets for them was significantly higher because of high interest rate environment. So the net interest margin was positive and underpinning their return on equities. But this time, we have much lower interest rates going forward. It means they have to think about other sources to ensure that they either stabilize their return on equities, or they at least are able to grow it using other non-interest related income going forward.
Right. And I would like to get quick responses from you both now. So from now till the next meeting, what needs to happen for us to see another bigger rate cut? I'll start with you.
Well, I think if we continue to see inflation rates decelerating, that's an indication of more cuts. Frankly, what they've done today is more like signaling what is to come. Because really, 50 basis points isn't much. If you think about how when this tightening cycle started, how they started, right? So it's not much. But I think if you continue to see inflation dropping, it then means that we might see further cuts. If we see, for example, where exchange rate is stable, what they do, with those liquidity and even liquidity we have in the system and the maturities that are coming, is also critical to determining what the next steps will be. But I think the cycle has started.
Right. Mr. Taj,
I think for me,
no risk of stoking inflation again.
Absolutely, for me, there is little or no risk. But I think, I said it earlier, by December, just because of low base effects, we are most likely going to see inflation around 29, 30% most likely. And by January, it should come back to 20% level. And going forward, most likely, we will see it below 20%. I reckon that we could see like up to 100 basis points cut in November. But the good news is that we should see corporates, governments at the subnational level coming to the market in October to come and issue bonds for growth and expansion of the economy. Fantastic. Most likely Lagos State in this case.
Fantastic. So much to expect, at this point. But we've got the first cut at this point. I would wait to see what happens next with Nigeria's economy, with inflation, and that's the currency, that's the naira, at this point. What's going to happen going forward? Thank you so much for helping us unpack this decision day. It's a special one, and I guess it did turn out to be special at the end of the day. Thank you so much, Mr. Hakeem Mohammed, Executive Director, Global Markets and Institutional Banking, FSDH Merchant Bank, and Mr. Tajuddin Ibrahim, Director, Research and Strategy, Chapel Hill Denham. Thank you both for helping us unpack this day. All right, so there you have it. We'll keep on giving you more reactions, going forward tomorrow on Business Morning and Business Incorporated. What this means for your money. Thank you so much for watching. I'm Ladi Williams. Bye for now.